Welcome to It's the Economy. We are 24 hours away from the monetary policy, and the growth picture has gotten a tad more disturbing, with the US president reiterating even higher tariffs on India. Now, with inflation already undershooting, does this growth scare give the Reserve Bank another reason to cut, and perhaps cut tomorrow itself? That's the question we'll be asking. The market will also want to watch out for other indications other than rates, like, for instance, liquidity. I have with me B. Prasanna, head of global markets at ICICI Bank, and economist Santanu Sengupta from Goldman Sachs. Gentlemen, good morning, and thank you very much for your time. Santanu, I noticed that you have cut the GDP forecast because of this 25% tariffs, but it's by very, very marginal, 10 basis points for the current year. Would that really prey on the Reserve Bank's mind? I mean, 10 basis points, 6.4% GDP growth, not a bad number.
Yeah, so the 10 basis points is because there's only 5 months left in the calendar year. On our fiscal year basis, we are at 6.1 compared to the RBI around 6.5. Now, I think what is important is what the forward-looking is on the tariffs. Our view is that this will likely not be the final word on tariffs, and as you can see, that there's been much progress overnight also. So we'll have to see where it finally settles at. I think the RBI will be looking at the mix of data. High-frequency data has been mixed. Rural economy doing well, urban. There's some signs of tepid data. Investment data on the private capex front, especially, has been tepid. And our sense is that the RBI might just want to wait out and see how things pan out over the next couple of months before moving further if they have to.
6.1, you said. My own poll had indicated 6.3, with everyone saying there is a downside bias because they had not yet factored in the tariffs. But just tell me, what do you expect the Reserve Bank to say in terms of inflation forecast? They are at 3.7. What will they say, and what will they say about growth, you think?
Our sense is that they'll have to bring down both the growth and the inflation numbers. I mean, inflation purely from a tracking basis, with a huge downside that you've seen in vegetables inflation, but more broadly, food inflation has been relatively contained. Our number is around 3% for the fiscal year and the calendar year. It could be a tad lower depending on where finally vegetables inflation settle at. I think they will also point out that core inflation has been inching up. The governor also alluded to it in the interview with you, and the forward-looking inflation is important from their standpoint. On growth, again, we think that they'll have to bring down numbers a tad bit. There's a huge uncertainty around growth given where this final rate of tariffs, and then there are like elasticity assumptions that you make on different products. Not everything will sort of get impacted in a similar manner. So I think with the uncertainty around growth, they'll have to bring growth down a little bit, but inflation clearly down towards 3% is what we would think.
Yeah, I think so. The poll, my poll indicated 2.9. So, coming closer to 3 is a must. Prasanna, therefore, a double question to you. If they don't cut rates, but bring down, inflation and growth forecasts, inflation substantially, how will the market react? If they cut rates, how will the market react?
So I think, Latha, either way, we do feel that there are things for the bond markets as well as yields and the market to look forward to. If they don't cut, I think they can't afford to speak hawkish in any case, because like you said, and like Shantanu pointed out, there is a downside risk to growth which has opened up. We have also kind of revised it a tad bit lower. Plus, there is a twist in the tail in the US Fed as well, now with almost certainty that there will be a 25 basis cut in September, and followed by a reasonably larger rate cut cycle, maybe extending for 125 basis points till next year. And the fact that inflation is going to surprise RBI earlier estimate by nearly 100 basis points in Q2, and the average inflation for the year going to be at around 2.9%. They need to bring it down by 80 basis. So if you look at all of this, plus the fact that the high frequency indicators have slowed down, the possibility of a rate cut has opened up. We would say that a rate cut between the August policy, which is tomorrow, and the next policy is almost 100%. Now, it is a toss-up on what the RBI really wants to do. Do they want to front load? I mean, this dispensation has been clear that they want to front load and give a fillip to growth as soon as they sight the space opening up. So do they do that? Or do they wait for a whole lot of other data like the GDP data, actual GDP data, then the Fed action and all that, and delay it further for next 2 months? But to answer your question more directly, I think either which way bond yields are headed lower marginally. But I have to say that as far as duration is concerned, there is not a significant large move that we expect though.
Okay. When Prasanna says duration, he means the 10-year bond is not, the yields are not falling much. Whatever changes you see, I guess you are expecting more in the T-bill and the 10-year and the 1-year level, right, Prasanna? That's what you meant.
Yeah, maybe up to 3, 4 or 5 years.
You may see yields fall.
Yeah.
Okay. Now, am I right that both of you are expecting the Reserve Bank to cut forecasts but not cut rates? Santanu, is that your position tomorrow?
Yes, we don't think there's a rate cut tomorrow. We think it is likely later in the year, possibly in the October meeting, maybe the December meeting, depending, again, on how things pan out. But on forecasts, we think that, yes, they will likely cut both growth and inflation numbers.
And that's also your expectation, Prasanna, right? No cut, but
no,
cut in forecast.
No, I'm not as strong in my views that there is no rate cut tomorrow like Shantanu. I think between tomorrow and the next policy, there will be a rate cut. You cannot discount the possibility of a rate cut tomorrow. The governor
intermeeting? You mean intermeeting rate cut?
No, I'm talking about RBI.
Yeah, I know. You're expecting RBI may cut between August and
no. Between the policy.
Okay, either this or that.
And the next policy. So it's either the August or the October.
Okay, I might tell you that our own MPC voted just 3:2 in favor of a pause, like Shantanu. So very narrow vote. And likewise, Ritu's poll, which we will shortly present, is also indicating the market is very narrowly placed between this or that. But what else will you watch out for, Prasanna? We know that it's a small change, whether the governor cuts and right away or sounds dovish so as to cut on September 30th is a small change. But what will you watch out in terms of other impulses from him?
I think if he doesn't cut rates, then what I'll watch out for is a language that he's using to, justify a neutral stance. I think earlier the neutral stance clearly came across as a hawkish stance where the rate cuts are not likely to happen. And that's the reason why the market felt that there is nothing forward-looking to look forward to from a policy perspective. But I think tomorrow the language that the governor will use will be very important. And the second thing is, of course, a whole lot of questions on liquidity. While RBI has been doing a very good job on managing surplus liquidity, and when liquidity gets taken away, also announce, short-term 1 and 2 day VRRs to give liquidity back. They've done a commendable job. But I think maybe clarity on what the liquidity policy framework is going to be in terms of usage of instruments and in terms of what are they targeting as a size of the liquidity surplus, and whether weighted average call rate versus SORR, which is the rate that they would likely to use for monetary policy targeting.
Okay, I don't know if they will say that all. They may give away the liquidity report, and maybe that will indicate. But yes, the market really wants to know whether are you watching TREPS or are you watching call rate? The charts will come up. Shantanu, guide us? What should we watch out for in the governor's language? Which sentences, which paragraphs?
In our view, the language is much more important for tomorrow. Look, I mean, if you think about the June meeting, they cut 50. Ultimately, financial conditions tightened through rates, both long rates and short rates being higher. That is because they moved from accommodative to neutral. So if you look at financial conditions in India from the previous meeting up to end of July, there's actually been a net easing only from the FX channel, right? Because your FX depreciated, or the trade-weighted dollar, trade-weighted INR depreciated. That is the only thing that really eased financial conditions for you. Everything else tightened, including equities. I understand for the last couple of days, given the rhetoric on tariffs, again the market is pricing in a little bit of easing. But therefore, our point is that the communication tomorrow is much more important than whether they deliver the 25 basis points of rate cut or not. So let's say, and Prasanna hopefully will agree with this, that if they cut tomorrow, and the market gets the signals that this is the end of the cycle, I would imagine that the curve will steepen and you'll not get a lot of transmission apart from what you would be getting in any case from the EBLR channels. And therefore, the market needs to believe that there is hope for something more to come, but not yet fully delivered. And that communication is important for transmission to go through in our view.
Actually, I was fishing for that answer from both of you, that tomorrow actually a cut will not be as dovish talk and no cut, because that keeps expectations alive. Just a final question, Prasanna, currency, it's went all the way to 87. I mean, our low is 87.97. What do you, will that prey on the Reserve Bank's mind? And in any case, what is your forecast, say, over the next quarter?
No, I think the currency spot depreciation is not likely to prey on RBI's mind. It's not done from a policy perspective so far. So I would like to believe that they will continue with that stance, that the currency rate will be a reflection of the macros and flows. As far as the what we think on INR itself is concerned, I think it's been unfortunate that even as the dollar weakens and even as the dollar weakens against most of the other developed market currencies, current account deficit countries and India in particular have not been able to enjoy that tailwind, primarily on account of the significant outflows or the lack of inflows in both FDI as well as in FPI. And hence, and also you have a huge short position in the forward dollar market, which the market knows that the RBI will be looking to recoup and close out at some point of time when inflows come. So RBI has turned out to be a buyer when the dollar flows come in. And also, unfortunately, because of this rhetoric on tariff actually increasing over the last 1 month or so, this actually means that the rupee needs to depreciate in order to regain the competitiveness from the exporter side. So I think a little bit of depreciation is in the order, and most of the negative things seems to be coming. The only saving grace is oil is still very low and heading towards 60 due to OPEC considerations. But on the other hand, if the Russian-related oil spike happens, then there could be an uptick in oil. So the forward-looking view on oil also is a little bit not very clear. So from that perspective, I think there is a little bit of a depreciating pressure on the INR.
Oh, that's an important takeaway, depreciation of the rupee on the cards. Thank you very much, gentlemen, for laying all the cards on the table. We would know, of course, in 24 hours what the RBI thinks. Wrap up on Bazaar. Chartbusters coming up.